Hi, everybody. My name is Jeff Adler. I'm the Vice President of Yardi Matrix. And today, I'm going to spend 30 to 45 minutes with you going over our view of the multifamily uh, market and where we see things kind of going in the coming years. So first, just to give you a context of what we're going to be covering, first, we're going to go over sort of a general context about where things are headed, focus on housing affordability, population migration, and then we're going to get into kind of the core sort of multifamily fundamentals, as well as investment strategy, and kind of recap 25 and where we see 26 headed. So first, what I'd like to do is kind of tell you where I'm headed in terms of the messaging, and you understand the entire presentation, and then you can see how I got there. And so first, from a macroeconomic standpoint, U.S. GDP did okay in the first half of the year. You had a negative half, you had a plus 3/8, a lot of very much trade related, but really it was about a 1.5%. And we believe it'll settle in, I'll call it around 1.25 range for all of 2025. With an acceleration of GDP growth into 26. On the capital side, Federal Reserve approved a 1/4 point interest rate cut in September, first in 9 months. I do see that there'll probably 2 more this coming year, the remainder of the year, and then we do see kind of it coming down. But the long rate's still kind of holding with the yield curve kind of becoming steeper. Inflation's holding around, call it high 2s, low 3s. Driven by reduced global trade and some tariff work. Further declines in inflation really depend upon the mix of energy prices, deregulation, lower taxes, higher investment, offsetting low labor cost increases, as well as a partial tariff pass-through. One of the unfortunate things that we're kind of seeing is that lower income households, about in fact 80% of the U.S. population, is under a meaningful financial stress, and the spending in terms of consumer spending is really bolstered by the top 20% of the households. Long term, that's really not a good thing, but it's helping in the short term. The labor market has kind of shown some recent softness. Because of the government shutdown, we don't have sort of official statistics, but ADP basically showed a minor decline in jobs. First time we've seen that in a very long time. And the revised data officially from the U.S. government actually had a rather significant revision downward, which kind of made job growth of the entire prior year kind of much more anemic. Now, the fact of the matter is we are seeing what appears to be an AI-driven productivity boost, which is giving us a sort of a supply shock, keeping the economy intact in terms of overall GDP growth, even as sort of the labor market kind of comes into a balance with lower demand and lower supply of labor. And then we do see growth kind of picking up in mid-2026. Now, with immigration policy decided, there's a new policy mix emerging with deregulation, tax cuts, lower energy costs, aiming to counterbalance trade and immigration cost pressures. So we kind of see this economy in transition, growing at a modest 1% to 2% rate. The big issue that's looming out there, it's not in the short term, but it is there long term, is very large federal deficits, which as a percent of GDP are 6.5%, 7%, very large, really lead to some kind of need a resolution. And we think that faster growth, some reduced spending, some kind of tax increases or reduced tax expenditures, something needs to happen. And I would refer you to Ray Dalio's great book, How Countries Go Broke, for some more. And the treasuries are in a 4.5% range, which is okay given where inflation is and is about kind of where it should be, assuming, again, the large deficits get some sort of resolution over the next couple of years. From the U.S. Multifamily perspective, in terms of the market's actually doing reasonably well. Demand continues to absorb supply. Rental demand for the balance or up until September has been pretty good, largely due to high home ownership costs, keeping people in their homes with higher retention rate, enabling sort of a new supply to get absorbed. September was not that great. It was the first kind of month where we really saw something kind of fall out of bed. As our new rent forecast comes in, we're seeing where we thought we'd see 2027 rents begin to move up to 3%. We see a less stellar increase nationally around 2%. Not bad, but a little, but underneath what we thought would happen. Market level performance matters a lot, and a lot of it's driven by supply and demand balance. So core markets are stabilizing. The Midwest, where rents have gone up 34% since COVID, are continuing to grow. The tech markets or the Sun Belt have been slowing rent growth due to oversupply, and these emerging markets are showing some strong fundamentals. Completions peaked in 2024, expected to decline through 2027. But what we're seeing is from 27 on, it's on par with 26, and we're kind of back to pre-COVID levels around 400,000 units in total of all kinds. And I'll break that out in a little bit. U.S. still has a structural housing shortage. And that doesn't really get resolved, I think, for the next 10 years. I would say that there is some attempt and recognition at a federal and state level that supply is the problem and needs to be addressed. And there is some encouraging initial moves, but we're not really seeing it all the way through. And supply being added still is at the high end of the market. And then we're going to look at the multifamily strategies. What's changed? How are investors adapting as rents and occupancy remain stable in the core markets, and then how they kind of targeting emerging tech hubs as the change that we saw this about 10, 15 years ago, and with the Sun Belt kind of positioning for recovery. So just creating a context. There's 5 big major trends, and then what are the implications of that? There's geopolitical and economic deglobalization. It is a big deal. It is sort of once every 30, 40 years kind of thing. We're seeing that in U.S. reindustrialization, nearshoring, and sticky-ish inflation. So very difficult to get inflation really down to 2. 2.5 is probably as low as it's going to get, and we're sort of in this 2.5 to 3-ish number as some of these trade policies work their way through. We still have a aging population and declining birth rates, which really means slow to no population growth, absent immigration, which largely has been decided. So we should expect relatively tight labor markets. So you need to pick the migration winners. We're still going through aftershocks from COVID. Now, the aftershocks are really in 2 areas. One, hybrid work and more remote work is kind of entrenched, even though there are some movements to attempt for people to get back to the office, but it's not really working all that well. And the bigger one is the debt has been moved onto the U.S. government, what we call a sovereign debt issue, and that does need resolution and is reaching its 40 to 80 year kind of high, spreading a U.S. population, suburbanization, smaller future cohorts, and larger long-term interest rates. Now, as we move into housing, a housing shortage is compounded, stunted supply growth, and absent significant state and local changes, the supply surge, which is ebbing, will pass without resolving the housing shortage. And I think that, unfortunately, is kind of where things are at, pluses or minuses, depending upon where you are. The other thing to note is there's a lot of political polarization. And as a result, local political risk is real. Operational regulation is real. And as a result, the local response to shortage matters. Is it one that enables abundance by adding supply and understanding the use of market forces, or is it allocating shortage? And those tend not to do very well in the long run, but can create sort of benefits for some people in the short run, and that really matters where you're doing business. Now, as we go to forward into a U.S. public policy discussion, the Trump presumed policy mix, so it's not necessarily fully articulated this way, but the reality is energy production is being encouraged, and you can see as this recording, energy and oil prices are below $60 a barrel in terms of oil, and gas is like $3.50 a decatherm. With electricity prices, however, kind of moving up. Government deregulation really acts as a back-ended tax cut, and then shows up hopefully in productivity increases. We're seeing lower taxes in the July tax bill, and there are some benefits there to encourage investment in all kinds of capital investment and lower taxes. Now, the security and trade policy and tariffs are really kind of linked from a geopolitical standpoint, further restricting, trying to move production out of China into other places. Now, those are sort of the first 3 tend to reduce costs, are disinflationary. Security and trade is inflationary. The immigration policy is designed to be inflationary. It's designed to result in higher labor costs, and so that's a feature, not a bug. Government spending still high, but the not really touching entitlements, and what that means, short-term interest rate reductions, but slow, long-term rates still hanging up there. Secondary and really housing policy is a secondary consideration to these first big things, but now with the amount of these things in place, the federal government is turning some attention. Once again, as this is recording, the government's still shut down. Hopefully, that as things move, this will be a little more attention put aside to it. The Road to Housing bill already passed the Senate. It's a kind of it's encouraging package, and we'll see if it gets out of the House. Now, when it comes to the sort of GDP view of things, where we've kind of got here is real GDP kind of slowing and then kind of picking back up again, with inflation kind of ticking back up and then kind of coming back down again, not getting below 2.5, 2.4. And then on the employment rate, both demand and supply kind of moving in, going up a little bit, then coming down. And then you've got basically your bond yield bouncing around between 4 and 4.5, and Fed funds kind of moving down gradually to 3, where you have a nice kind of steep yield curve. And that's about as low as it can get, really, with if that kind of aligns with the fact that we think inflation kind of comes down. It's on the long run basis, you got to generally the 50 basis points over the inflation rate is a good short-term rate. And so we're moving in that direction. But obviously, inflation getting down below 3 will be required in order to get the short-term rate down to 3. Now, if you look at overinflation and kind of pick it apart, what you kind of see is that housing really is the long pole in the tent. And given the fact that renewal rent increases are running around 3.5%, 4%, it's very hard, and that's what the inflation CPI housing index is primarily based on. It's very hard to get overall inflation rate below 2 unless you've got everything else kind of down to 1. So this is about as low as it's going to get. And until interest rates come down and housing costs come down, this is about as good as it's going to get. Now, federal debt, this is a real thing in terms of percent of GDP. It's bouncing around 120, and the deficit around 6.5 during an expansion, 6% of GDP. This is really high. It's not sustainable. It needs to be addressed. And the fact of the matter is, the best way to address it is something akin to what happened in the late 1990s with Bill Clinton and Newt Gingrich. Again, all laid out in Ray Dalio's great work on how countries go broke. Now, in terms of money supply and inflation, we're kind of back to trend. Now, we were elevated at this kind of level. As we saw that big inflation spike, we came down a bit, but now you're basically running at that same, I'll call it 5 to 6% growth in M2, which is consistent with 2.5 to 3% overall general price inflation, general price inflation. You could have prices go up and down of certain goods and services, but until you have an explosion of the money supply, you're not going to get general price inflation. But we're certainly not getting back to this trend line that existed from the GFC up to the COVID era. The point I did want to make here in terms of consumer spending is, if you look at this and decompose this by income group, what you're going to kind of see is the higher income groups, because they've also had access to financial assets, which have grown enormously, they're doing fine in terms of consumer spending. But the middle income folks who don't have financial assets, which haven't been able to get those hands on financial assets and grow, they're kind of struggling, since wages and prices have moved pretty much kind of closely together. Now, as we move into housing affordability, the fact of the matter is we just don't have enough housing starts per 1,000 households. That's just a fact, and it's a long-standing issue. It's just been compounded coming out of the GFC, and it's really quite structural in nature. If we see this is a great infographic driven by some data for Up for Growth, which is a nonprofit that we support, which really kind of lays out the fact that they're relative to trend. There's a lot of underproduction going on, even in Florida, even in Texas, but especially you can see in New York, Illinois, and California. But this is kind of what's driving that. And if you look at this, the reason that all this is kind of happening is the cost of owning a home is dramatically higher even than the increase in rents, which have spiked, 25% since pre-COVID levels. But the cost of a home payment with other sort of items in there, even at a 90% LTV, it's just really too high. Plus, you have to come up with a down payment. at an elevated level. So this is what's leading to higher retention, lower turnover in multifamily, which has kind of made a big divergence between new lease rent growth and renewal lease rent growth. Now, again, when we split this apart by we call this renter by necessity and lifestyle, upper income versus modest income kind of properties, what you kind of see is on a cumulative basis since '07, the increase in rents in the lower end of the economic scale has far outpaced income growth. So even as rents have gone up overall, rents at the lower end of the economic scale have gone up even more. Now, this is not an expense issue. I'm not talking about profitability. I'm just talking burden on the consumer at the lower end is much higher than at the upper end of the economic scale. And we do see that in an elevated rent to income ratio data. This comes from our screening division. Now, it has kind of leveled out since 2024, but you do see still, and if we go back this kind of pre-COVID level, where it was about 28-ish% at the renter by necessity, it's now in the 31, 32 range. So there is an increase in burden even above wage and rent growth. And if we take a look at this, some of the markets have significant focus on the renter by necessity component of this. Anything is over 30% is viewed as kind of a little bit out of line. And you can kind of see not just the big cities, but even smaller cities, the sort of increase in costs relative to incomes at the lower end of the economic scale definitely say that consumers are under pressure. I think it's important to note that. Now, and this is just our work that we've done both on market rate and affordable to describe the inventory of the 25 million units that we have in the housing stock and the distribution of that. And so in many cases, right, market rate properties do serve the same community of renters as affordable housing. And there is to a certain extent, a fair amount of competition between the two. And this is just some data we have in terms of breaking all of that affordable housing segment of within. We have 125,000 properties in our data set. 24,000 are completed. Fully affordable, and we break them down by who owns it and the programs. And just kind of a note is how big a deal it is really does kind of depend upon, in most cases, it's the kind of the Northeast where it has the largest percent of the total housing stock. Now let's move forward and talk about the overall population growth. And so you can see that we had this surge of international immigration, non-citizens, but the overall population growth has been decelerating, and after this surge is expected to continue to decelerate into the 2040s. And as a result, and one of the things I believe that why it will not change, and the change in immigration policy is enduring at least for several decades, is the foreign-born share of the population right now is akin to the same number that it was back in the 1890s. And that was at the high water mark of a significant amount of international immigration at that time from Southern and Eastern Europe, now from Latin America and other places in the world. And that led to restrictive immigration policy embodied in the 1924 immigration law, which really was not turned around to the 1965 immigration law 40 years later, which then led to you can see this gradual increase where it's crested. So I think we're in this place for several decades. And when it comes to state-to-state migration, we're kind of back to pre-pandemic norms in terms of the number of people and the places that they're going. So we're kind of back to where we were. And then if you look at this is the cumulative increase in population from COVID, and you can kind of see just, Texas and Florida and the Southeast were the beneficiaries of a lot of people moving. This is a meaningful amount where Illinois, California, New York actually lost population, and population growth is mitigated in other parts of the country. Now, this is a little more recent. All this is saying, to a sense, is that the same trends are continuing, but at a lower pace, right? You can see the Mountain West, the Southeast, and Texas continuing to gain population, but again, at a slower pace than had been in the past. And now we do our own population projections on a go-forward basis. And so, again, the greatest population growth over the next 5 years that we project will be outside of gateway markets, as they had been, and in the Sun Belt and in the Mountain West. And then the question is, how does demand and supply interact and relate to each other in terms of housing market overall performance? We also see a continued aging of the population, and that has implications. Now, the population has tended to be healthier, but that hasn't translated into labor force participation. And then we go over here. This is a key issue. If you look at the 25 to 54-year-olds, prime working age, their labor force participation is back at the same level that it was pre-COVID. The real difference is that the 55 and older, which are growing as a percent of the total population, their labor force participation is down about 6% relative to pre-COVID levels, and that's the issue. And I wouldn't take too much stock on the 16 to 24-year-olds. There's a lot of seasonality in that. Now, again, over the last year, if you look at that labor force participation rate, it is growing among men 25 to 54, but there's fewer of them, and declining pretty much everywhere else. And part of that, among particularly women 25 and over, is, as some research I've seen recently, is as there's been attempts to return to the office, that is moving some women to, because of childcare costs and other sort of family responsibilities, to step back a tad. So we think that this movement of return to office is actually not really in the best interests of the overall economy, and it's acted somewhat as a back-ended reduction in force actions, particularly among technology companies. And now if we look at the foreign-born labor force participation rate, that is gone down quite a bit. And if you actually, if we looked at this, there's actually been about 2 million fewer transmittals from the U.S. to Mexico, indicating that, in fact, the immigration policy pursued by the administration has having an effect in reducing the supply of labor, as the demand of labor also come in, which means that the sort of overall labor market is somewhat in balance, but at a lower level of job formation in a meaningful way. Now, let's shift a little bit now to what's going on in the actual multifamily industry. And here you can kind of see is the big run up, 25% increase in rents, but September was a rough month for the rental market. And you can kind of see here this decline in September in asking rents is significant relative to prior historical averages. September tends to be, coming off of the summer high, a bit of a downer. But this one is a significant move down. And you can kind of see, again, this is more the fact of when expansions occur, they tend to be led by the lifestyle. As supply hits, lifestyle underperforms. Rent by necessity goes up slower, but hangs in there longer. That's exactly what we're seeing here. If you look at this, this is data from the expert transaction data set. We are seeing sort of a deceleration, obviously in new rent growth and in renewals, but overall rents still going over nationally. Okay, nationally is an important differentiator. Now, asking rents here, this is really just a question of you're seeing in the Northeast and Midwest, not a lot of new supply hit, a modest amount of new demand. Rents are growing there. In the Southeast, a lot of supply that is kind of working its way through the pipeline, and as a result, rents are down for this period of time until all this stuff gets absorbed and rents reaccelerate, as we'll kind of cover in the next section. Occupancy is about kind of back to where it was, but there is a difference by market. And absorption, this is a key issue. Absorption was very strong in the second quarter. It's kind of, okay in the third quarter, but you see a noticeable slowdown in total absorption. And also obviously a reduction in units as we're seeing, but conditions in the market are sort of slowing a bit, and we're seeing that throughout. Now, as you look at this on a market by market basis, a lot of the markets that are tertiary are doing quite well. They've had a little bit of increase in demand, not a lot of increase in supply. And so you see the Midwest, places like Cincinnati and Dayton and Grand Rapids, Cleveland, having decent 3% rent growth. And again, not the 7%, 8% of yore, but still hanging in there and very stable, and retaining the COVID pop that they originally got, 30-40%. And you're seeing these other markets respond to supply, and rents are declining there. Now, very interesting thing to note is we are seeing 2 bedrooms outperform. This is a new lease trade outs. This data comes from Matrix Expert, which is transaction data of paired leases. So these are paired units. So it's a best measure of actual rent performance. And you're seeing in that 2 bedrooms outperform ones. 2 bedrooms are in scale a good proxy for home ownership and the cost of homeowns. There's not a lot of 3 bedrooms in the data set, but again, you can kind of see these new lease tradeouts on twos well outperforming 1 bedrooms, particularly in some of these markets here in the Northeast and Midwest. And then this is on the renewal side. Okay, renewals also doing well. This is the 2 bedroom renewals, outperforming 1 bedroom renewals, with the exception possibly of San Francisco, which is kind of having an AI kind of resurgence. But that's very important as well. Now, it's particularly of note to kind of look at the new leases versus renewals. And you can kind of see, the exception of Manhattan and Chicago and northern New Jersey, renewals are far outperforming new lease tradeouts. And this is a very important thing to kind of see. This is also look at that even on renewals. San Francisco is doing quite well. Very important, because this is basically saying this is the effect of an older customer base, and one that really does not want to move much, be willing to pay up to stay in place. We're also seeing this on the 2 bedroom side. So the whole portion of this is that we're seeing retention increase, i.e. turnover go down, and on those units that are not turning over, increases in rents, which is really supporting the revenue stream of properties even in high supply markets, which is why we haven't seen a lot of stress or distress. Multifamily units in lease up are beginning to decline. This is just manages just new supply as well as other units in lease up. So again, that makes sense. We're seeing that. And then as we move toward our multifamily forecast, there weren't a lot of changes. We just updated the forecast in 25 and 26. We had anticipated 3% in 27. The other ones were about the same, actually a little bit lower. But you're seeing kind of 27 be a little bit longer in the recovery than had been anticipated for. Then our rent growth projections focus on new leases. Now, when you look at completions, yep, they're kind of coming down, but this number was just reforecast and had been around 350, popped up to around 400 or so, 406, something like that. And that's very consistent with the 2019, 2020 level, on a pre-COVID level. And if I went back further as well. Now, what's going on here? Okay, there had been a significant expectation that 27 deliveries would really be low and there'd be this resurgence in rents. We're not quite seeing that. And as we unpack that, the mix shift is about the same. We're not seeing a difference. New supply forecasts do include a fully affordable, but we're seeing that mix be roughly stable. The pace of starts in 25 versus 24, which is happening right now, kind of about the same. In fact, 25 is slightly ahead of 24's pace, and delays in construction and cycle time have kind of stretched out a lot of those deliveries, so that's what's driving a lot of it. And there is a little bit of a mix shift away from the Sun Belt or to the California, Midwest, and the Northeast, but not so significant that, again, the Sun Belt is still where a lot of supply is coming. Again, we see the starts number. We also track this. Our starts are confirmed starts, and obviously they will go up as the year progresses. But again, on a month-over-month basis, we think they're about the same as 24. Over a 5-year period of time, these numbers aren't scary. Okay, 2 to 3% is the percent of stock on an annualized basis, but that's not out of line. There isn't suddenly a collapse in supply, but it's more like a return to somewhat kind of normal over a 5-year period of time. So these units will be absorbed over time, but that also means that, again, rent growth will be a tad more modest. Now, one of the things that we want to take a deep look at is this is the sort of high supply markets and their kind of new lease rent forecast. What we did is we went through an exercise that said, hey, let's take into account the fact on a revenue basis, if you're purchasing a property, you're also buying the renewals. So we went through an exercise that basically said, let's factor in those renewals and the rents we're getting on those renewals. And you can kind of see that by 28, 29, there isn't much difference. But for 26 and 27, these renewals cushion the impact of the current rental performance and give you sort of, 2 1 to 3% kind of rent growth, which kind of keeps in overall NOI in a decent place, given some expense growth. And that means that one, we're not going to see a lot of stress or distress anyway. We're just going to see some stress, but not a lot of distress, and acquisitions can still make sense. And to our clients, we'll be posting this at a market level on our subscriber portal. Now, again, if you kind of go forward in this, you kind of say, hey, some of these markets are doing well. We do think sort of 26 kind of comes down some, a slower economic growth, or a slower labor market. Maybe you have economic growth, but you don't see the kind of labor market growth, to modest rent increases across these markets. On a transaction basis, even we have 25 kind of come back, we're basically at I'll call it a recessionary level of transactions. I do think there's enough dry powder and enough loosening of expectations that we will see a pickup in activity in 2026, probably 10 to 20% higher than we've seen in 2025. That'll still basically just get us back to kind of a pre-COVID level of activity. Now, this was an interesting chart we kind of put together, which looked at what are we seeing in terms of price changes pre-COVID to current, and what's the overall volume. So volumes obviously are down in a number of places, but we're also seeing in this color shaded values go up in certain places. Okay, so in Kentucky, in Arkansas, in Pennsylvania, in Michigan, again the Midwest, we're seeing increases in values. Okay, even in places, obviously you have a decline in values we're seeing in the Sun Belt and in the West, but it's very much of a regional perspective that's worth taking into account. And I do think that this will probably continue until the Sun Belt kind of is clear that things are turning around. I do think we'll see some clarity of that over the next several months. Loan maturities are ramping up. And so from here to 2029, you've got a lot of loans that are going to come due and have to be handled and have to be refinanced. Now, the ones that were bought at the peak in 21 and 22 are the ones that are the most vulnerable to stress. And the ones that maybe with 2019, you also have a big run up in income that will help kind of buttress the increase in cap rates that have occurred over that time frame. And there is basically a spread here. Cap rates really have not moved much, even though the spread has compressed significantly, right? And so that basically kind of tells you that there's an expectation that values will continue to hold up, and I think they have. One thing we did want to kind of cover is just looking at expenses and property performance. This is some data that comes out of the expert system of the accounting software on an aggregated and anonymized basis. It does indicate that expenses have been a real problem, and the cumulative expense growth has been meaningful, where expense growths have grown 33%. Conventional unit revenues have gone 28%. And so there has been, obviously, income is highly leveraged, and so overall NOI is in probably a good place, but expenses are definitely something worthy of consideration and worthy of tackling to get those under control. And then if we look at these on the pieces of that, it's well known that insurance costs have grown significantly, and they are up to 7.5% of total costs. But we're seeing kind of a leveling in the last year of the further increases in insurance costs, and where you need to go for is utilities and some other sort of marketing and admin costs. Overall expense growth, which had been 5 to 8% over the past couple of years, now on a trailing 12 basis, 2.5%, kind of in line with overall inflation. So further action certainly can and should be taken on expense growth, but at least from a sort of acceleration, we're not seeing it further accelerate from here. And this is just to know that there are significant regional variations. The darker the color, the higher the percentage increase in total expenses, and then the number is actually the actual dollar amount. So there's definitely geographic variances and how expenses have risen, and the impact that it has on NOI. Now, moving our way towards investment strategies, this is a kind of a review of some things we did back in May. Core markets, they're okay. Rent growth has recovered. Occupancy has stabilized. There is meaningful office to apartment conversions, especially in these urban core markets. It's not a huge thing, but it's still there. The issue in core markets is really political risk. The local government wants to have development, but political risk kind of works against that opportunities. They want development, they want housing, but they don't want to have people make too much money doing it. So that's navigating that is basically your chief opportunity and risk. We've identified a set of next wave markets that are sort of smaller, but are basically benefiting from reindustrialization and energy production. They're doing pretty well. And they really are the sort of next group of what were Sunbelt's major centers. Now, the Sunbelt recoveries are large, big, fast-growing markets. They had a big run up in rents. They had a big run up in supply, and now that's getting delivered, which is basically, while it's slowing rent and occupancy growth, is also setting up the next cycle of economic growth in these cities. And they have gone through the same cycle over the last 50 years. But this one was a big cycle up and a big cycle down, but it's very consistent. And this is just a way of kind of currently looking at rent growth, arraying them from top to bottom in terms of their performance. And then as we look at this, we kind of see, absent kind of the New York, a bunch of these sort of emerging markets, Midwestern markets, look like they're going to perform really well this year, going to perform pretty well next year, as some of the sort of hot markets, high supply markets, high growth markets are going to go through a period of consolidation and some hard work over the next couple of years. Now, just kind of saying about, look at these core markets. What do we see, right? So in May, we were saying, hey, we think they're recovering, occupancy stabilized. What do we see? And that's largely true. Boston, Seattle, Washington, modest rent growth. LA is slightly down. Chicago and New York have really performed quite well. These are financial centers. San Francisco is now in a full recovery mode. We saw that several months ago, and as it was beginning to recover, the political risk issue is still there, but public safety is better, and you got an AI kind of boom happening, which is pulling the Bay Area up. And so again, the San Francisco Peninsula is outperforming the East Bay, but the region, the East Bay is kind of the lagger. Silicon Valley and the Peninsula are doing better, but you're not really going to have significant population growth there, and they are affected most by international immigration pullbacks. Now, as we go talk about these next wave of emerging markets, we've identified a group of cities, smaller in nature, kind of overlooked, that really are where I think some significant opportunity is presenting itself and is worthwhile in terms of your investigation if you're a national player. And what I would say here is that these cities are benefiting from a level of AI, data center development, reindustrialization, energy production, and they are benefiting. Kind of Kansas City, Madison, Wisconsin, Milwaukee, Oklahoma City, Omaha, Cincinnati, Columbus, Georgia, which is south of Atlanta, Dayton, Indianapolis, Lafayette, which is kind of northwest of Indianapolis, Lexington, Louisville, and Kentucky, major manufacturing going on. So these are markets that I think are definitely worthy of your consideration. They've got good affordability. They've got relatively inexpensive land. They're recorded significant rent growth during COVID, and they're sustaining that growth on a go-forward basis. So definitely worth you taking a look at. You can see here in Cincinnati and Columbus, meaningful announcements and developments just since May of this year in terms of the continued investment in all of these cities. And I do think this is definitely something, again, worthy of your consideration. These are the kind of conversations we were having 10 to 12 years ago, talking about the Raleighs, the Charlottes, the Orlandos, the Tampas of the world, the Nashvilles of the world, where they weren't fully adopted yet. They were still a little early stage, and folks who moved into those markets have been significantly well rewarded. I think this is the next phase of that. CBRE identified a few also emerging tech talent areas for AI. Now, in the Sun Belt, these are really popular cities. I love them all. They are broadly diversified. They're large. They're going to grow. All you're seeing now is a big supply wave that's delivering, and that needs to get absorbed. And paradoxically, one might say that the decline in rents is basically rebuilding their affordability for another leg up over time. And if you look at that, starts have declined sharply across those markets, and we do think that the deliveries will be modest in those markets. Absorption was pretty good in the second and third quarters, but September was a rough month. So there are sub-markets within these larger markets that do present opportunities, and rents are growing there. But we do think that a recovery is going to take a little bit longer than had been hoped for. But again, renewals cushion the impact of that, and recoveries are still growing at a more modest rate, but still in a pretty decent shape, and some markets will recover earlier. So, kind of recapping, what did we think was going to happen, and where are we going now? We thought that multifamily completions were expected to decline, and they have. We thought they declined further in 27, and we don't think that's going to happen. Core markets are stabilizing. Immigration was offsetting out migration. That is less so. Chicago, New York have been recovering. San Francisco is kind of on an upswing, and immigration inflows have definitely slowed due to enforcement. In fact, there's probably some outflows going on. The next wave markets are operating as predicted. I do think there's an opportunity to get into those markets, and the Sun Belt is recovering. It will take some time. It's going to take a little bit longer than maybe hoped. 27, it may be a little bit later. As some markets a little sooner than others, but the bottom line is those markets are recovering, and overall the markets are. The multifamily market is in pretty good shape, and long run the issue is making sure that we resolve the housing shortage. So what do we think as we look forward to 2026? Supply will continue to wane. Completions will decline through 26, 27. Demand is probably kind of receding. Occupancy rates, we do think, will remain relatively stable. Rent growth is going to occur and stabilize at high 3% in 2028, but the path there will be more gradual. We do expect transaction volume to pick up mid-year 2026. We do think that the tax law benefits will take time to emerge, but they will be there, and that will power economic growth in the middle of 2026. And so we do see the economy doing well. There are problems at the lower end of the economic scale. We do see unemployment not really getting too much of a problem, but going up a little bit before it comes down. We do see a steepening of the yield curve. And we do think that AI is providing us what we call a supply shock, increasing productivity, driving down costs that enable, along with the tax benefits, for growth to reaccelerate. I would say, again, 27, 28, the government sovereign debt issue has to get resolved. It definitely has to be resolved by 2033. That's when Social Security benefits will be cut by 27% if no action is taken. So sometime between 2027 and 2033, the U.S. sovereign debt issues do need to be resolved. We are seeing concern around that in the run-up in gold. So that is a concern that is in the capital markets. Again, that does need resolution. Not today, but it does need to get resolved. So all in all, I want to thank you for your time listening to this, and kind of hopefully it was helpful. There's my contact information, and the lawyers make me kind of show up the copyright notice. So I'll do that, as well as a disclaimer. And I hope you have enjoyed the time that we've had to spend together. And I thank you very much for your time today. Take care.